Vanguard strategic asset allocation models. That's what we're going to talk about here today on the Heritage Wealth Planning YouTube channel. So if you like what you see here, we're talking about everything under the sun when it comes to financial planning, investments, estate planning, tax planning, Social Security planning, Medicare planning, you name it, we talk about it here. So if you like what you see, subscribe down below right there. And then hit the bell to be notified for future commentary, because I'm doing at least a video a day now, probably 2 or 3. And you want to keep informed, because it's not just one topic we focus on. We don't just talk about Social Security or talk about investments. We talk about everything. And you want to keep focused and keep getting the notifications that we're doing a new episode. So this is what I've been waiting to do for a long time. Talk about Vanguard, the strategic allocation models that they have using their exchange traded funds. I cannot tell you how excited I am to have this discussion. The problem when you work for a firm is that you can't do and say what you want to say. And I get that. I mean, it's their firm. They want to make sure you don't go, off the limb and, start talking crazy nonsense that they got to police up. But I've always been a fan of Vanguard. And I shared this with you numerous times. I had John Bogle. He actually personally signed his Common Sense on Mutual Fund book, the first version that came out in 98 or 99, which I have here in this house. And you can have it because I keep it, because I love John Bogle. He's one of my heroes. But anyway, so I've always been a huge fan of Vanguard. And for the longest time, Vanguard was looked at as the people in the investment industry hated them because it costs the investment advisors money. That's a fact. You just can't perform against Vanguard on any consistent basis. Not if you're charging a fee. It's just, it's not impossible, but the vast, vast, vast majority of people who attempt to lose. Now, are there some folks who can beat them? Sure. Can you identify those people today? Nope. You don't know who they are. Just because they did over the last 5 years, there's no evidence whatsoever that they'll do it over the next 5. In fact, the only way you know to beat a Vanguard portfolio is if you're concentrated, very concentrated, and they call this active share to some degree, where you're saying, hey, the broad market is 5,000 stocks. I'm only going to get 20 stocks as various degree in some category. And if that category just takes off like a bat out of hell, you're going to do great. You'll smoke the index, that's for sure. Will that do it consistently? No. Well, can you do it consistently? No. Can you say, I'm going to go after this one focus this year, I'll take all the gains, and next year I'm going to go after that focus and do the same? No, it's not. You cannot repeatably do that. You just can't. And so because that, the smart money says you can't beat them, join them. And I can't beat the Vanguard. It's just too low of a cost. So I'm going to join them. And we're seeing advisors do that now. And now that we have ETFs, exchange traded funds, that you can get in a brokerage account and charge a fee for managing the money, all of a sudden I know where the epiphany of the investment advisory world has joined in. They say, look, I can invest in Vanguard broad market funds and they cost 10 basis points and still charge 1% as a fee. And so instead of giving it all of the client's money to some money manager who can't beat the market, I can at least get the money myself and get broad-based index funds to at least cover the market. And what the vernacular is in the investment advisor industry, you never get fired for investing with Vanguard. You never get fired for investing in Vanguard, and the SEC will never come at you for investing with Vanguard. And so over the last 10 years, Vanguard has just, again, raised a flag, not only for individual investors, but for the investment advisory business as well, which I kind of chuckle at. All right, so let's dive into what their recommended is, because I personally don't think you need to pay a fee for investment management. In fact, I don't invest anyone's money. If you want me to tell you what you do, I'd be happy to do so. But I'm not going to invest your money. And the reason is because you can do it yourself very, very easily. It doesn't take a degree in rocket science. You don't need a PhD in French FAMA 5-factor investment analysis. You just find a good, broad, diversified portfolio, which I'll share with you here today. Put your money in it and never change. I mean, it's literally that simple, and make sure the expenses are low. And I will put that portfolio up against any other portfolio any day of the week. On any given 3-year time, yes, we will underperform. Over the course of a 30-year history, we're going to outperform the vast majority of your neighbors and the vast majority of the investment advisories out there. And the reason is simply because we're diversified, which is you're spreading your risk among many asset classes, and we keep our fees low. And that's even before we talk taxes. I mean, you start throwing taxes in there, fees and taxes, you can't compete against my portfolio right here, because you're paying fees and you're paying taxes more so than I'm paying fees and more so than I'm paying taxes. and you don't have the investment prowess to overcome that bogey that you already started with. I mean, that's a huge chain on your back right there, fees and taxes that I don't have to overcome. And you do, and you have to do it consistently. And if you ever follow the IRA, the Irish Republican Army, remember they always used to say about Margaret Thatcher, all it takes is for us to be successful once when they're trying to assassinate her. Now, I know that's gruesome, but that's what they said. We just have to be successful once, where Margaret Thatcher has to be successful 100 times. The same thing is true in the investment world. You have to be successful 100 times. Now, you might be successful once, but you're not going to be successful repeatedly 100 times over. Just not going to happen. So let's dive into what Vanguard talks about. This is from March 2018. If nothing else, this should be your bread and butter. This is where you should start the program of how you're going to invest your money. I'm not going to read all this to you. I'm just going to go down into what their core series are, because I find this to be interesting. Again, I'll link it in the show notes here. But basically what they're saying is you got 100% allocation of some equity to fixed income, 100% bonds to 100% equities. Equities are just stocks, my friends. That's it. So remember, a bond is you're loaning money to a company or a government, all right, a company or a country, but you're loaning money. You're a loaner. A stock is you're an owner. All right. So a loaner is safer because a bond, even if the country or the company goes bankrupt, in theory, you have rights to all the goods that they have in their store. So you have rights to the cars they have outside. You have rights to real estate. You have rights to their assets that they have. That's the thing about being a loaner, a lender, is that you still have rights even if the company goes kaput. They have to consolidate everything and sell it, and you can get some of that. As a owner, the only thing you have rights to is if the price of the stock goes up. All right. So the business makes money. If the business pays a dividend, you have ownership in all that for sure. But if the business goes kaput, you are wiped out. And that's the difference between a loaner and an owner, or a lender and an owner, however you want to look at it. And so what happens is, because of the risk inherent in being an owner, you get more upside potential. And I got to quantify potential. Everyone says stocks do better than bonds. Not necessarily. We don't know that for sure. That might have happened in the past, but you cannot extrapolate what happened in the past with what is going to happen in the future. We have no clue. No clue whatsoever. In fact, if you look at 2007, October to March 2009, stocks did not do better than bonds by any stretch of the imagination. So you cannot say stocks do better than bonds, and then what they'll quantify that in the long run. Well, what is the long run? Keynes said in the long run, we're all dead. And so the long run is what could be the long run for you might be different than the long run for me. Just had to turn my phone off there. All right, so let's talk about it. So just remember, if you want more protection, you want to be a loaner, but you're going to sacrifice growth. There's no getting around that. If you want more growth, you're going to be an owner, but you're going to sacrifice short-term protection. And there's no guarantee either of these things are going to work for you. We just don't know. And that's why a combination of a loaner or an owner is probably not a bad way to go. But Vanguard gives us what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 different models. And I'm telling you, this is your starting point right here. And if you want to be 100% loaner or 100% owner, we can look at this. And they're saying on the bonds, which are the blue, their portfolio consists of 68.6% in the total bond market index, ETF, BND, and roughly 30% in the total international bond index. So that's it. That's it. You want to have these two, you want to have bonds, 100% bonds. You put your money in this portfolio, 70% in government bonds or U.S. bonds and 30% in foreign bonds. Now we'll dive in a little bit what are the constituents in these bonds. But for right now, that's as simple as that. On the other hand, if you want to be 100% stocks, you put 60% in domestic stocks and their ETF, VTI, which is the total stock market index. And then you put 40% roughly in their international stock, which is VXUS, and their international stock index. And there you go. Voila. You are 100% diversified in the stocks, and you are 100% diversified in bonds, depending on the risk that you want. And that's it. Literally those four things. So let's go 50-50. As you can see, we have 30% roughly in the U.S. stocks. We got 20% in international stocks, 35% in U.S. bonds, and 15% in international bonds. You just can't beat that portfolio in terms of simplicity or fees. You just can't. It's a wonderful portfolio. U.S. stock market is essentially the 5,000 stocks that are in the United States. It's called the total stock market index. International stock index is a little bit more convoluted because how much of that is emerging markets, how much is going to be China versus Europe versus Australia versus Africa. There is some risk management there in terms of someone's got to say, well, we think Africa should represent 10% of the total stock index for the international. And we think Europe should represent 80%. I mean, there is some issue there, but keep it simple, stupid. It works like a charm. Look at these fees. 0.11 for international bonds, 0.05 for international U.S. bonds, 0.11 for international stocks, 0.04 for U.S. stocks. You're talking, what's that, 30 cents or 40 cents for every $1,000 invested. I mean, it's essentially free. I mean, you're talking 40 cents is the fee for every $1,000 invested in the U.S. stock market, 50 cents for the U.S. bond market, $1.11 for international, and that's you can't beat that. I mean, it's insanely cheap, and that's what's wonderful. So let's see right here. The weighted expense ratio on a 50-50 is 7 basis points. That's 70 cents per $1,000 invested per year. It's incredibly cheap. I mean, all right. And so look at that. So, and they always keep 2% in fees and money market. I don't know why they do that, but I guess just to have a little bit of exposure to cash. A lot of people get mad about that. Cash is an asset, my friends. I mean, if you look at Craig Israelson, he has these 7-12 portfolios where you have 7 asset classes with 12% in each. He has commodities, real estate, cash, bonds, and so on and so on. And cash is an asset class. And I don't get why people get all up and stuff like, I got all this cash. It's not being put to work. It is being put to work because cash actually has a value to it. You're not getting much growth on it, but that's not, if you're trying to get growth, you don't have cash and really you don't have bonds. Growth is being stocks. If you want preservation, you have bonds and cash. That's all there is to it. All right. So anyway, they got 2% cash. And that's your breakdown right there, which I like quite a bit. Let's see what it's done since inception. And then we have a huge track record of performance because they've only been around since 2012 and 14 and whatnot. And that's where you can kind of look at the life strategy funds that Vanguard has. And I'll do another thing on the life strategy funds. But here it is. Since 2014 to 50-50 has averaged 5.8. I don't know what to compare that to. But, at the end of the day, you're 50-50 stocks and bonds, you're getting 5.8, which is essentially where Vanguard says you should be before inflation right there over the next 10 years, roughly, 5 to 6%. And it might even be a little bit higher than that because you throw these 50% bonds in there. Where's the growth going to come from? Well, there's no growth in bonds. Where's the yield going to come from? The coupon, the interest that you get. But still, if you're getting 5.8% net of fees over the next 10 years, and this is 50-50, I'd be very comfortable with that, frankly. If I can get we'll just round up 6%, 50-50 portfolio net of fees, and the taxes are going to be very, very minimal in here. In fact, the ETF taxes, if anything, they're basically non-existent. If I get 6% year over year over the next 10 years in a 50-50 stock to bond portfolio, I'm not crying over spilt milk. I'm very, very pleased with that for sure. Here's a stock portfolio since 2012, 7.52, which means it doubled in 6 years. That doubled your money. You put almost exactly. You put $100,000 in there 6 years ago, it's worth $200,000 today. Here's your bond portfolio over the last 6 years, 2.3. And there's the difference. The stock portfolio was up 12.5. The bond portfolio was up 2.3, going back to the same time. Unfortunately, a lot of people will say, I don't want that bond portfolio. It's only done 3. I want the stock portfolio. It's up 12.5 without the first idea, the risk inherent in just tracing the numbers for sure. Just remember, folks, I'm not telling you not to do this, but we have a stock market that has had yet to have a major correction of any significance. We've had a couple smaller corrections in 2011. One happened in 2012. 2010, and we're talking corrections, not even bear markets, like 18%, 11%. And then the beginning part of 2016, I think the broad U.S. market is down 15% as well. Now, emerging markets, we just got out of a bear market, and we've had another bear market in 2015. Small caps had a bear market in 2015 as well, but the broad market as a whole hasn't had anything even close to a major bear market since 2009. We just haven't had that. And here, if you want to get a little bit even deeper, they use where they offer highly diversified balanced investment options with the University of Chicago Center for Research and Security Prices. You can actually get, you can slice it up even more. Small cap, large cap value, large cap growth, developed markets, emerging markets. You can see that. I frankly don't think you need all that stuff. I think just covering the basis with these 4 is fine. The VTI, VXUS, BND, and BNDX, and you figure out what you want to allocate. If you want to do 25 across the board, nothing wrong with that. It's completely up to you. But if you want to slice and dice, here they can slice and dice even more for you. And again, the weighted expense ratio gets a little, well, it actually does same expense ratio of 7%. All right, so let's go down to the S&P 500 or the S&P series. Highly diversified balanced investment options distinguished by the broad market of the S&P Standard & Poor. And here again, you got the same thing, S&P 500 extended market index, just a different tickers. And you can see here they even got mortgage-backed securities. So they got short, long, and intermediate bonds, and then mortgage-backed securities like Ginnie Mae. If you want to slice and dice some more, you can do that too. Nothing wrong with that. Same expense ratio. It's completely up to you. You got the Russell series, which is based on the domestic stock indexes from Russell. Same thing. You got Russell 2000, Russell 1000. Again, you can slice and dice it every which way to Sunday. And now we got our income series, which is an income series of ETF. Strategic models offer highly diversified balanced investment options distinguished by their broad market core portfolio designed to generate risk-controlled income. I don't know. That might be something you consider. At the end of the day, I've always said, and I will say until I'm blue in the face, and I'll do a video on this one point, the 3 buckets. I need income. It should be in cash. I need income for the next 2 to 3 years. Just put that sucker in cash and be done with it. And just tap. It was like a checking account. From 3 to 5 years would be my bonds. 3 to 6, maybe even 3 to 7. So if I need income for the next 3 years, it's in cash. Let's say I need $50,000 a year in income, of which Social Security gives me $25,000. So 50 is what I need. 25,000 is guaranteed by Social Security. That means I need 25,000 a year. 25 times 3, put $75,000 in cash. All right. Now from years 3 till 7, that's 5 years. I need $25,000 a year, 5 years. So that's 25, 50, 75, 100, 125. So I got 75 in cash, 125,000 sitting in bonds. And that's 200,000. Yeah, it's 200,000 bucks right there. Anything else can be in stocks. And that is literally that simple. And you can even say 1 to 3 years in cash, 3 to 5 years in bonds. The issue is we want to make sure you do not sell stocks when they're getting killed. We want to make sure that does not happen. So we want you to have enough cash to avoid that. Anyway, so I hope this helps, my friends. There's a lot going on here, and you don't need to slice up too much. My goodness, at the end of the day, you can see what's going on with the various ways to manipulate your portfolio. The problem, the more you manipulate it, well, the more active you're becoming as an active manager. And I don't believe, and you shouldn't either, that active management works relative to just broad-based passive investing, where you can just put it in there and set it and forget it and be done with it. There's just no evidence of this. Now, that people say, well, Warren Buffett's active. Yeah, but you're not Warren Buffett. You're just not. I hate to say it. You did not have the option to buy Goldman Sachs in 2007 and 2008 when it's trading on pennies on the dollar. You just didn't. Warren Buffett did. Now, if you want to invest in Warren Buffett and Berkshire Hathaway, more power to you. But the idea that there are active managers that have done well relative to the broad-based market does you can do well. It's a straw man. Those two things are not hand-in-hand tied. They're just not. So I hope you find this interesting. And if, as always, if you here, you even got more info on the various ETFs they have. If you like what we do here at Heritage Wealth Planning, click on the button to subscribe. Hit the bell to be notified for future content, because we're doing a bunch of episodes a day. Thumbs up always help me. That tells the YouTube algorithm, our overlords, the YouTube algorithm, that people actually like the content, and they'll be more inclined, the YouTube algorithm overlords, to share it with other people as well. So hit the thumbs up, please. And as always, comments are always welcome. Lastly, go to theheritagewealthplanning.com. You'll see my book. You get a pop-up where you can get this for free. It's downloaded for free. Just click on the pop-up. You got to put your name, first name, email, and your state, because I am going to do state-by-state analysis of various things as well. And if you're a part of that state, you might be interested in that. So your first name, your email, and your state, and you will get the PDF of this. You can always go to Amazon.com, type in Josh Scanlon, and you can get this for free under Kindle Unlimited or $4.49 for Kindle regular too. So we'll see you next time at the Heritage Wealth Planning YouTube channel. Thanks, guys.